Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another edition of our Never a Dull Moment Currencies report, and I'm joined as usual by Dan Bell from HiFX. Happy New Year, Dan. And
you too, Gareth.
Thanks for joining us. I guess the big sort of news in the last week has been Japan. Now, obviously, Japan is a real case study of what's going on in the rest of the developed world now, given that it's had zero or near zero interest rates for 20 odd years. The whole money printing thing, etc. But we've had some changes from the Bank of Japan, and what is all that? What are they exactly, and what's that going to mean?
Yep, so the Bank of Japan have announced this week that they're going to double their inflation target from 1% to 2%, and they are going to embark on open-ended quantitative easing. So essentially Japan is going to print money until they get inflation up to 2% and until their economy starts to gather some momentum, and part of that mandate also is to weaken the Japanese yen and ultimately make their exporters more competitive. The Japanese yen has been a reasonably strong currency over the last few years. It's considered a safe haven currency despite their economy struggling. It's still considered a safe haven currency because they have had reasonably low private sector debt, very high public sector debt, but very low private sector debt. So this has been flagged to the market, and you've seen the Japanese yen weaker against all major currencies. Against the New Zealand dollar, it's depreciated by about 15% since the start of December last year. So in 2 months, you've seen the New Zealand dollar go up from sort of the mid-60s to where it is this morning, which is over 75 against the Japanese yen, and that's the highest that we've been since 2007, 2008.
And with Japan, taking this type of action, what does this mean? I mean, obviously, it's pushing the New Zealand dollar higher. Presumably, it's pushing other currencies higher against the yen as well. We're hearing a lot of talk about currency wars. I mean, what else is going on around the world at the moment?
Yeah, this is the thing. I mean, at the end of the day, everyone wants a weaker currency in this environment, but a lot of the major economies have taken their interest rates to near zero levels. They have been doing sort of unconventional forms of stimulus to try and create more stimulus in their economies, and part of that is also trying to weaken their currencies to make their exporters more competitive. You've got everywhere really. If you talk about the Bank of Canada this week talking about the high currency and the impact that that's having on their economy. Norway and Sweden were talking about the impact of the currency. The Bank of England talking about the currency this week. Obviously the Bank of Japan doing something, actually out there printing money. Even some of the leading commentators in Australia talking about the high currency and the fact that the Reserve Bank of Australia are going to be more likely to cut interest rates this year to help bring the currency lower. So it's a big topic at the moment, and it's going to be a big issue for New Zealand this year on a trade-weighted basis, as we're still sitting around 5-year highs. Excuse me. Against the Australian dollar, we have been trending up. We're well over just over the 80-cent mark at the moment against the Aussie dollar. Against the euro, we're still sitting around multi-decade highs, and against the pound sterling, close to all-time post-float highs. So it's going to be very interesting what the Reserve Bank of New Zealand has to say about all this next Thursday. Yeah,
obviously next Thursday we've got the official cash rate review. Now, I guess no one really expects them to change the official cash rate from its record low of 2.5%. But really, everyone wants to hear what Governor Graham Wheeler's got to say about this New Zealand dollar and this situation that we've got going on around the world. I mean, firstly, what do you think he will say? And secondly, what do you think perhaps he should say?
Well, so we've come back, 2013, the last few weeks, we've come back and in general global sentiment has been reasonably upbeat. So you've seen some of the earnings reports out of the US better than expected, although Apple has been underperforming. Chinese data has been better than expected. It looks like China's economy has turned a corner. The underlying sentiment towards Europe has been much better lately. You've seen the bond yields on a lot of those big European economies continue to come lower and to more sustainable levels. Not that the European economies are creating any real growth, but it seems that the underlying debt situation is more sustainable. This overall environment has been considered risk on, so positive for currencies like the New Zealand dollar. So there is an underlying fundamental reason why the New Zealand dollar would be seen as more attractive, but clearly in a situation where global central banks are cutting interest rates still, or they're printing money, our exporters are feeling the pinch of our high currency. And at the end of the day, it's going to be a challenge for New Zealand to grow in a sustainable way through exports if our currency continues to go up. So the challenge for the Reserve Bank of New Zealand next week is, despite having a stronger Auckland property market and the Christchurch rebuild flowing through to house prices and to inflation, overall it seems that the New Zealand economy still has some major challenges, and the currency is going to be one of those challenges this year.
So perhaps we should see a bit of action from the Reserve Bank on the currency front?
Yeah, I doubt it. I think it's going to be fairly steady as she goes, to be fair.
A few comments?
Maybe a few comments, Certainly I don't think we're going to see any kind of action from the central bank in terms of intervention. I think, at the end of the day, they've got a tough job. We don't have the pockets to go out there and start intervening. We don't have the appetite to do things like the Federal Reserve or the Bank of Japan or the European Central Bank, for that matter. The challenge also, I think, with the Reserve Bank of Australia, if they start really cutting interest rates, I think it's going to be very difficult for us to talk about even raising interest rates any time in the next 12 or 18 months. Yeah,
I mean, certainly, at least publicly, there's no pressure on our Reserve Bank to do anything in terms of currency intervention coming from the government, is there? I mean, Bill English and John Key are not they're singing from the same hymn sheet as Graham Wheeler, really.
Yeah, pretty much. And I mean, at the end of the day, in a perfect world, the market should determine the value of your currency. But the challenge is that we've got these other central banks that are undertaking very interventionist type policies, which has a real impact on trade flows and the real economy. So it's unfortunately it's not a perfect world. So New Zealand is just a small economy that is being exposed to a lot of these other policies that we've got absolutely no control over.
You mentioned we don't have the pockets deep enough to, I guess, intervene. What other options do you think they could look at then, if they wanted to, which they appear not to?
Well, you could cut the cash rate. That's one
that's
way.
The obvious one. Yeah.
That's one way of bringing down the currency. This year, I think, is going to be interesting. I mean, I don't think we're going to see the OCR cut this year, although it's going to be interesting if the Reserve Bank of Australia cuts interest rates as much as some analysts are expecting. Now, the cash rate in Australia is at 3%, ours is at 2.5%. You've got some analysts calling the cash rate in Australia down to 2%. So if that was to happen and we remain at 2.5%, that has the Kiwi-Aussie cross rate, in my opinion, up at 85 cents. And that could easily unfold this year. 85 cents is actually around the 10-year average for the Kiwi-Aussie cross rate, and that's going to have a big impact on our export sector, because Australia is still our largest market.
And the Reserve Bank of Australia, their first cash rate review is the week after next, I think February 5th.
Yeah.
So they're at 3% now. Are we expecting a cut as soon as then?
No, it's about a 40 to 50% chance of a rate cut in February from the RBA, but looking out further, we are seeing the market price in a 100% chance of a rate cut from the Reserve Bank there. So, but no, on the 3rd, I think it's the 3rd of Feb, Tuesday is the first meeting of the RBA this year, and it will be very interesting to see what they say. So watching that one closely. And in the next week or so, we also get the employment figures out of the US. So the non-farm payrolls, which is the jobs growth number for January, and the unemployment rate. And as we know, the Federal Reserve has this focus now and a target for the US economy to bring the unemployment rate down to 6.5%. So any movement which is better than expected will obviously be interesting. And I think the big one to watch, really, that I don't think anyone's taking on board enough, is as we get closer to this 6.5% unemployment rate, the potential impact that the removal of the Federal Reserve stimulus out of their economy is going to have on global markets, and I think that's going to be a big one to watch this year.
Yes, and I mean, obviously they in the US, the politicians cobbled together a fiscal cliff deal, as most of us expected, just right in the nick of time. They've kicked the can down the road in terms of the debt ceiling issue. So I guess the short-term focus is really on the performance of the US economy, and signs there are looking better, aren't they?
Yes, that's right. I mean, the PMI number out of the US overnight, much better than expected. You've seen the jobless claims numbers, which represent the number of people getting the unemployment benefit there, much better than expected. And the housing market in the US, which, the housing market tends to be a huge driver of economic growth in the US economy, that's really starting to show signs of momentum. Even some of the most bearish economists and analysts out there over the last few years are starting to call the US economy up this year on the basis of the recovery in the housing market. So it wouldn't surprise me to see the markets get a little bit of a shock by the time we get to the middle of the year. I know a lot of people are saying that the New Zealand dollar's got a lot more upside against the US dollar this year, some calling it up as high as 90 cents. I don't buy into that view, because I think ultimately the only reason the New Zealand dollar is the levels it is against the US dollar is because of the quantitative easing program that the US central bank have in place. If you take that out, I think we could easily see the New Zealand dollar trade back into the mid-70s, and to be fair, that's probably where it belongs. It's probably fair value in this day and age is probably between 72 and 78 cents, and at the moment it's sitting around 83.5.
Well, thanks for that, Dan. That's Dan Bell from HiFX, and I'm Gareth Vaughan at interest.co.nz with another edition of our Never a Dull Moment Currencies Report.